Good afternoon, everyone. My name is Stephanie Arasate, and I'm this year's International Development Roundtable Coordinator. On behalf of everyone in the IDEV department, thank you so much for making it out to today's event with Martin Spicer. The SICE Development Roundtable is a high-profile speaker series where leaders and practitioners within the international development sphere address our students, faculty, and the broader community on trends that are shaping the field. Today, we will hear from a SICE alum, Martin Spicer, who is the Director of Blended Finance Program at the International Finance Corporation. Blended finance is a critical new finance tool used by development finance institutions to support private investment in some of the most challenging environments. The IFC and the World Bank are among the leaders in deploying blended finance to achieve the Sustainable Development Goals and transform billions in development assistance to trillions. Today, Mr. Spicer will discuss the World Bank Group's journey in developing blended finance global initiatives to address pressing development issues by crowding in private capital and enabling private sector solutions. So please put your hands together for Mr. Martin Spicer.
So thank you very much, Stephanie. And do we have Bologna on, or? No. Okay, hi to Bologna. I was in Bologna myself, so I'm very excited to speak through the system here to you guys as well. So I'm going to talk to you about blended finance broadly as a tool for international development for private sector. And IFC and the World Bank Group's journey on this path of using blended finance, defining for you what blended finance is, and then going into some details about how we manage the blended finance operations at IFC. Because when you're using subsidy, which is in the blended finance as we define it, it's very important to be careful with that use, particularly when you're using the subsidy with private sector companies. And so it raises a whole bunch of different issues IFC's operations on our own don't really have to address, because we're operating in effect without subsidy in our normal operations. And the World Bank, when it does its public sector operations, operates with a certain understanding of the subsidy involved, and there's certain rules around the use of that subsidy. And so blended finance for me combines some of this kind of private sector commercial operations with also their and how you use, in effect, public subsidies. So what grounds our work at IFC and the World Bank are the Sustainable Development Goals, which I'm sure this audience is very familiar with, and you probably know more than I do about the history and whatnot. But these goals were born in Rio de Janeiro in 2012 at a UN Sustainable Development Conference. They were codified and formalized at the end of 2015 and guide the UN's work in particular, but now multilateral development banks and development finance institutions like IFC and bilaterals. And if you look at these sustainable development goals, many of them you can imagine how the private sector can be relevant. So if I look at something like education, number 4, private delivery of education, gender equality in many different ways in private sector operations, or providing products and services for women. Clean water and sanitation, you have private delivery. Clean energy, that's one area where there's a significant amount, and to be honest, mostly private sector delivery. So many of these sustainable development goals are goals that can be delivered and satisfied by private sector operations. And in fact, at the same time that these sustainable development goals were formalized, there was a conference in Addis Ababa which emphasized the importance of the private sector in development. IFC has been around since 1955 as the private sector arm of the World Bank Group, funding private companies. But it hasn't always been the flavor of the day when it comes to international development. That is sort of the private sector as part of that effort of sustainable development. But in 2015 at Addis Ababa, there was a broad consensus among the donor countries, the current delivery agents, institutions, that private sector was very important to helping achieve these goals, because public sector on its own would not be possible to deliver on all of the aspirations. And so coming out of Addis Ababa, a renewed interest, and I'll show you ways that has manifested itself in leveraging the possible from the private sector to achieve these goals. Just one fact in this complicated slide I want to highlight to you. So the needs are about $4 trillion a year to meet those sustainable development goals. And today, the spending is only about 1.4 trillion. So there's 2.5 trillion of gap there. The private sector is providing much of that 1.4 billion, 900 million today. And so this 2.5 billion gap is where is the money going to come to fund that? And much of it will still come from taxation in countries and from public sector MDBs like the World Bank, but much of it needs to come from the private sector. When people talk about going from billions to trillions, they're talking about the billions that are provided by the traditional MDBs to trillions that can be provided by others, particularly private capital. I think many of you know IFC and the World Bank, but just to remind you, we're part of a group of other development institutions, many of which are shown on this slide. And I'll just focus on IFC, but many of these other institutions do similar things. So we provide advice as IFC to take what we're experiencing in the trenches of private sector sort of structuring of deals and their operations to help those companies get to be bankable, to help them with their financial management, their environmental and social aspects, governance, and also helping to advise governments, and that's maybe getting more to the policy guidance and knowledge, to understand what the private sector needs to invest. And so we bring our hands-on experience, and our colleagues in the World Bank bring more policy, regulatory experience to that part of what we do to help stimulate more investment by the private sector. And IFC, of course, invests and lends and provides guarantee products and helps syndicate to other commercial banks. So that's our investment part of the business. And that's traditionally what people think of what IFC does, is finances the private sector. But we do this advice work and some of this policy guidance as well. And then finally, we try and set standards in different areas. So some of you might be aware of the Equator Principles related to environmental and social standards. And those were created by IFC and sold to other multilateral development banks and commercial banks as principles and standards that should be used and applied whenever investing in projects that had some kind of environmental or social impact. And we're right now, some of you might be familiar with the additionality principles, impact investment principles, which IFC has shared out to the public and trying to get feedback on what qualifies as impact investing, as a way of not having sort of impact washing done by a lot of equity funds and others. So this standard setting is something we do, and I'm mentioning that because when it comes to blended finance, we've also been part of establishing a set of principles on how to use concessional funds. By the way, if people have burning questions, feel free to stop me, and we will have time at the end as well. So just this slide shows you the evolution of a variety of different MDBs that focus on the private sector since 1991, and you can see this increasing investment by all of them over the last 5 years, 10 years really, and I think there's going to be even more after this Addis Ababa agenda. So just very quickly, IFC is part of the World Bank Group. There's the IBRD, which lends to middle-income countries. There's IDA, which lends to poorer countries. MIGA, which provides political risk insurance. And ICSID, which works on arbitration and related to investment disputes. And one thing that I've been at IFC now for over 22 years. And there's been different efforts over that period of time to try and bring these different parts of the World Bank Group together. I've been part of one of those related to municipal finance and lending to sub-sovereign governments on a commercial basis rather than with sovereign guarantees. In this blended finance space, and I'll talk about that a little bit later, because all those shareholders of ours after Addis wanted more effort done to support private sector, that's not just institutions like Ifc investing more, that's institutions like the World Bank, rather than making public sector loans, setting up a regulatory framework that attracts private investment. And so there's a broader effort at the bank, I don't know if you've talked about it in your courses, labeled Maximizing Finance for Development, MFD for short, which is an internal acronym, but really designed to push bank staff to think about, is there an alternative to lending to the public sector with all that subsidy that's implied, to helping the public sector create an investment framework, regulatory environment that attracts private investment to come in. And that is bringing the World Bank and Ifc closer together, because Ifc staff have more of the hands-on investment experience. And then in blended finance, there's certain things that bring us even closer together. And I'll talk about that as we go on. So this slide is detailed, and I'm happy for you guys to have these slides. I'd appreciate if you don't share them too widely, but I'd like you to have them as reference. So as I was saying, the World Bank does a lot to help the public sector. The government is the client of the World Bank, and the private company is the client of Ifc, except sometimes we advise governments also on privatizations and attracting investment into new infrastructure projects, for example. And we are trying to demonstrate what's possible with our regulatory advice and then actual projects that Ifc invests in. And one of these new blended finance facilities, which I've highlighted here, called the IDA 18 private sector window, is where we're really coming together as institutions to help solve development challenges with some public sector solution, some private sector solution, and some subsidy through the blended finance tool there at the right time, at the right moment. We're also in the context of a new strategy at Ifc. So I talked about maximizing finance for development at the World Bank. At Ifc, with our CEO, who actually used to work at the World Bank for 25 plus years, an economist by training. And he also has an MBA, but he's really an economist. He came in and said, look, you guys have been talking a good talk about focusing on the poorer countries, but if I look at the history and the data, it doesn't show that you've really moved the needle much. And so he came in and said, look, we need to, rather than wait and have people come and present us with projects to invest in, we need to go out and help create those projects. So it's called the Creating Markets Strategy, Ifc 3.0 to sound digitally cool, and building on an Ifc 1.0 and 2.0. But it's kind of interesting, the history here. So 1.0 was when Ifc was set up in the 1950s, was really helping US, European, Japanese companies invest in developing countries. So it's very much foreign direct investment. And then about when I joined in the mid-90s, we started having more and more clients who were based in our country, so local sponsors, we would call them. And those local sponsors were growing their businesses. Those local sponsors were crossing borders into neighboring countries. And that's this Ifc 2.0. And then the 3.0 is taking advantage of what we know about investing, what we know about private sector, and in the toughest countries or in the toughest sectors in not so tough countries, that we go and we help make things happen rather than being more passive. And that's Ifc 3.0, and there's a number of strategic areas I'll focus on a little bit later. So we have maximizing finance for development, pushing the bank to do more to support more private investment. Ifc going and trying to help create opportunities in that space, that emerging space that one can imagine the bank work is helping create. And with that joint story, Ifc and the World Bank went to their shareholders last year and said, we need more money to be able to realize these strategies. And so we had a successful vote on a capital increase for both the World Bank and Ifc based on these strategies, very much focused on private sector. IFC had not had a capital increase since the early 90s, 25 years. The World Bank goes back about every 5 years and has a capital increase. It's part of their business model. IFC's business model has been to price for the risk that it takes and make profit on that. And so we took $2.5 billion of capital from our shareholders in the early 90s, and today have $25 billion of capital and lend off of that capital base and the bonds that we issue. But to achieve the goals of IFC 3.0, which were really increasing what we do in the toughest countries, we needed to have more capital. We were going to be taking more risk, and we needed more support from sources like blended finance. So I'm saving the bit about blended finance for a little bit later. But this is all building up to why is it blended finance important. So some of the things that we promised our shareholders that we would do with the new capital was increase by up to 40% of our total investments in IDA countries and fragile and conflict countries. So IDA countries are the poorer countries that the World Bank and IFC work with. 35% of what we do by 2030 is going to be, according to our goals, climate related. So climate is the big theme, fragile, low income is the big theme, and then finally gender is another big theme where we increase our investments and we increase women in management positions on the board as clients, and so it's a broader goal, thematic in nature. So fragile, low income, climate, gender. And these areas happen to be the ones where we use blended finance the most. So just a couple quotes, one from Jim Kim, our president of the World Bank Group. We must now leverage our scarce resources even more to crowd in vastly more private capital, combine it with our expertise, public and private, and invest in developing countries. So Philippe Leroux is the CEO of IFC, and he talks about deploying new tools to achieve these goals. And while blended finance isn't new, it's 10 years old, more or less, as we've been using it, but it is new in the sense of the amount that we are using to achieve our goals. So blended finance has a broad set of definitions. So now I'm going to get into more the blended finance part of the talk. And I want to start with this slide and this big circle of the OECD blended finance universe, because the OECD has a definition of blended finance, which I have there on the top left. The strategic use of development finance for the mobilization of additional finance towards sustainable development, so for the SDGs, in development countries. So this is a very actually includes what IFC does using funds when we invest in private companies. And it's a definition useful for donor countries for their allocation of overseas development assistance. It includes technical assistant advisory grants, and it includes mobilization that IFC does, which means when we make a loan to a company, we might sell some of that loan to a commercial bank to take the risk alongside of IFC. So we're mobilizing, catalyzing others to come in. When I talk about blended finance now going forward in this presentation, and as we define it at IFC, it's a smaller set of this, which is on the right. And I'll show you a definition slide in a minute, but it's using concessional funds together with commercial funds. And that's a smaller set than this broader definition that the OECD uses. So blended finance for us now is a tool to help us achieve what I was talking about of IFC 3.0 and those goals. And if I look at IFC's strategy today, we have focus industries, infrastructure, agribusiness, financial inclusion, health and education. Focus challenges, climate, fragility, digital economy, and focus regions, Africa, MENA, South Asia. So this is a corporate slide, so this is what we show the world and our shareholders. Now, if I look at how does blended finance, the funds that I manage, fit with this strategy? it's basically helping support IFC in nearly all of them. And the ones that it's not, we are in the process of finding donors to provide funds for health and education in middle income countries, bottom of the pyramid, and digital economy, so early stage digital solutions, particularly in Africa. And then cross-cutting themes, gender is one actually where we have dedicated facilities from donors to tackle that issue. Disruptive technology, capital markets, so one of our existing facilities is also related to local capital market development. My point here is that we're trying to link what we have as a strategy, which has been validated by our shareholders, with the source of money. Sometimes what happens in the development world is you have a lot of supply of money that's looking for someone to do something with. And people say, yeah, I'll manage your money, I'll do something with it, but it's not necessarily coordinated with an institution strategy. And what I'm trying to do, and what we're trying to do institutionally, is make sure when donors come to us, donors being shareholders, country, development agencies, come and say, we have money that we think should be used for refugees in Ethiopia, that we're not just taking the money to employ ourselves, but it actually fits into our broader strategy. So this is the slide that has that definition. That is a definition that we've jointly come to with other development finance institutions like EBRD, Asian Development Bank, FMO in the Netherlands, CDC in the UK, which is combining concessional finance from donors or third parties alongside of a DFI's normal own account finance and or commercial finance from investors to develop private sector markets, so it's focused on private sector markets, address the sustainable development goals, and mobilize private resources. So one part here is critical to notice is alongside DFI's normal own account finance and or commercial finance. So the way IFC so far has been using concessional money is we have an IFC investment and a concessional investment, co-investment together, and we call that blended finance. We don't just invest the concessional money without an IFC investment. There's some other DFIs that do, and we've included that in this broader DFI definition. But it's concessional money into a private company where there's private capital, even if, say, FMO is not investing its own money into that company. And you can imagine, well, that can work. For us at IFC, we felt that having the discipline of IFC, making its own investment, going through the rigorous IFC process, all the integrity on the sponsors, the environmental and social aspects, the market, is commercial, the sponsors know what they're doing. So my team doesn't have to do any of that because I know the IFC team is doing it. So from my perspective, there's a benefit. You can still get all those things in terms of discipline of investing. If you're just investing concessional money from, but it can be a little bit problematic. So when I say, now I'm going to talk a little bit in detail about blended finance as a product and when we use it. So here's a continuum. There's some operations, some enterprises, some that require permanent subsidy. You think about, say, education here in the area. I mean, taxes, it's not subsidy so much as it's tax money being used to pay for teachers in schools. But, or you have a subsidy in the water sector. So many places it's hard to, people can't pay for something, and so governments decide, okay, if it's a social good, we'll subsidize this. We're not using blended finance as IFC in situations where we have permanent subsidy situations. Or when it's not fully commercial and needs long-term subsidy. So this might be that water utility that needs a continuing subsidy to keep certain neighborhoods supplied with water. We're not using it there. We're using it where it's not fully commercial yet, and needs some kind of short-term subsidy to bridge to the point in time where it becomes commercial. And then we try to stop ourselves from using the subsidy when it's commercial, because then it's a waste of subsidy. And further on in companies that are fully commercial, can raise money in the local markets, we're not using blended finance. Yeah, so that's a good question. Let me get to part of the answer in the next slide. So I mean, one of the limitations that we put on ourselves, or the providers of the capital, is where we can use the money. So it's not like we can go use it on K Street here. They're saying in developing countries, in the poorest countries, you've done what you can as ISC to invest, and there's more projects that need to be funded. And so we'll make this subsidy, in effect, available in those markets. Or thematic, so climate related. So people in many countries have made commitments related to climate, and they need to spend their money to achieve those, whether it's in their own countries or in developing countries. And there's an agreement at COP, and COP is happening right now in Poland, that the rich countries give money so the poor countries can mitigate climate or climate adaptation projects. And so there is definitely limits of the types of projects or the geographies, and I'll show you in a couple of the graphs where we've been active and where we're growing. This slide is a graphic that gives a sense of, again, from the structuring side and the product side of blended finance. So for those of you that have done corporate finance or other types of finance, you'll see on the left, there's different types of investment products that an investor like ISC use: equity, debt, guarantees, and the World Bank product there, the partial risk guarantee, which is used to help backstop the credit of an off-taker of a power project, like a government-owned off-taker that buys the power. And even sometimes with these instruments and some of the existing risk mitigation tools, like that partial risk guarantee, there might still be excessive risk in the project, which means pricing is very high and then not affordable. There might not be enough access to finance in that country. So that's another reason to use, for ISC to be there, just with our own account, and to use blended finance. There could be high upfront costs. It could be a first mover going into a market. And then there could be insufficient returns, at least perceived from the beginning. So these things that talk about sinking the deal from an investment officer's perspective who's trying to put together the deal. They might present it internally or think about presenting and say, like, this isn't going to fly according to IFC's normal investment standards. I need some support from blended finance in the form of concessional interest rate or some kind of risk protection as a guarantee on my investment. And that's where we then move into, so what is it that blended finance can do? So we can provide guarantees with the capital provided by donors. And again, the guarantees are usually not priced commercially. So they're priced at a level that makes the whole project affordable, the financing affordable. Subordination. So a subordinated loan from a blended finance source can help protect the senior debt in a company. Local currency financing. So we're using one of the blended finance facilities we have access to help IFC source local currency, to work with counterparties that are too risky for IFC to work with normally, so in a swap arrangement. Pricing, as I mentioned, and tenor. So, if you make a loan that's really long term, it's usually more expensive. If you look at your mortgage on a house here in the US, or generally the longer the loan's outstanding, the more expensive it is. So we play with some of the tenor, the maturity of the loans with the blended finance tranche. All to help deal with some of these barriers to investment of the normal types of products, say, that ISC would use. So this is the structuring side. So I have to justify using an instrument from my toolkit of blended finance tools that is helping the commercial side of ISC do the transaction so that it's generating enough of a return for ISC. Because again, that I told you, like since early 1990s, ISC has generated profits to keep itself sustainable, to be able to lend more. And also so that the other capital providers, the shareholders in the company, also are getting a decent return. And there's some science to that, because we can look at risk-adjusted returns on capital, we can look at investment returns for the shareholders, and through our judgment and experience know, is that high or low or about right? And if we're using subsidy, we want the answer to be it's about right or low for the capital providers, because that makes us feel more comfortable that the subsidy is not going to benefit the shareholders just to line their pockets with more profit. So the other aspect besides the structuring side is the economic side of blended finance. And this slide is a product of some work that we did with our economics team on rationale for using concessionality or subsidy with private sector operations. And there's actually not a lot of academic work in this area, so we weren't able to leverage a lot of other people's thinking. And we came up with 3 different cases to use, and they're not exhaustive, but they give a flavor of what we can consider at the decision point of using blended finance. One is positive externalities. So if there's clear social, environmental externalities that go beyond the project's sort of direct influence, or another way to say that, don't come as a revenue stream to the project to help repay the loan, but they're externalities to the project and social returns, then that can justify a certain level of subsidy. And sometimes we try to equate directly the level of subsidy with that economic benefit if we're able to calculate it. A second area would be demonstration effects. And in many of the markets we operate in, there's just not a lot of information. So if you're an investor trying to go into the markets, you'll price that uncertainty into your return expectations. And what we try and do with the subsidy element is reduce that cost, the financing cost, so that the overall returns for that project look okay for the shareholders and for the lenders. And then finally, affordability effects. So in many of the markets, again, that we operate in, consumers don't have a lot of income. And when you start a business and you're trying to get to the mass market, let's say of power or other services, then you have to deal with this affordability issue. And sometimes it's getting the company running so that it can get to an economy of scale that then is sustainable without the subsidy. And so that's the idea of affordability effects, which sometimes is what we use to justify the use of subsidies. Now, that concept of economic rationale for the use of subsidy is the first of the blended finance principles that I referred to earlier. And these were a set of principles that IFC, with some of the other DFIs as far back as 2012, set up. And with those principles, our board then allowed us to be using concessional funds alongside of IFC's own investments. And these were revised last year. And not to go into detail on each one, the first one is that economic rationale for subsidy. The second is that we try and use as little concessionality as possible, so minimum concessionality, and trying to crowd in others. So we don't want to bring all this concessional money so that private providers can't come in. We want to use as little concessional funds and subsidy to crowd in others. Commercial sustainability. So this is that temporary use of concessionality. So we want to look and see, can we see a path to commercial sustainability, in our projections, in the market, And we try and make sure that we see that. Can we know for sure all the time? No, but it's one of the things we try to assess. And then reinforcing markets. And this is another way to think about it, is not distorting markets. Because when you use subsidy in markets, it can sometimes create investment around it that is not sustainable, that without the subsidy won't happen. So the other part of this principle is that we're designing the market or helping the government create a regulatory framework or investment framework that is creating space for investment. We're not just supporting one project that on its own will be fine, but it's not a step towards more investment. So you need to reinforce market principles more broadly as well. And then finally, the last one is promoting high standards, and this is where we talk about our environmental and social standards, our integrity standards, governance, and that those all come as part of an IFC investment and should come for anyone who's using concessional funds, because there's even more scrutiny from taxpayers when using public funds, particularly in private operations. You can find these if you Google DFI, Blended Finance Principles, IFC on our website. And we've written pages on these too, so you can spend some time doing that. There's another aspect for those that think about these things of governance within an institution. And just quickly there, so we have IFC operations that make investments with IFC's own commercial capital. And then we have a separate decision-making group for the concessional funds. And then we have a separate department, my department, outside of IFC operations, who are kind of the guardians of those principles and the investment structuring. And so there's investment officers and operations officers on my team that work with the project teams, and help support them, because we exist to help IFC do more, but they also negotiate against those project teams. Do you really need that much concessionality? Or how can we describe this project or redesign the project so that you have more impact? And so these are two of the governance things that we at IFC have put in place, and different institutions do the governance in different ways, but it's a really important part of blended finance. Just quickly, I've talked about the investment part of blended finance, and earlier I talked about IFC's advisory operations. We often, when we go to donors, we talk to the donors about a pool of money that we can use for investment and for advice, because we found that when we put the two together, we have better outcomes. And so these are examples of different projects, and we've done tens or dozens of advisory projects, oftentimes like one for the investment projects. And that could be to help a bank set up a SME lending department. It could be advising those SMEs on putting business plans together. It can involve teaching farmers how to increase their productivity yields. So all kinds of different advice to help with the business, to help with technical aspects. And we also do it with environmental and social. So another thing to keep in mind is the blended finance, the subsidy element, is really designed to have more impact than we can have as IFC with our current models. And so one thing that our shareholders and donors really want to see is, are we getting more impact with this subsidy that we're using? IFC has put together in the last year a new way of measuring impact, anticipated impact measure and monitoring system, AIM, which gives a score. When we present a project to our board, we actually have a score from 1 to 100. Independent score from the economics department at IFC looking at the investment project. And it gives us a way to see, are we having a differential impact when we use blended finance? And it's about 15% higher scores when we use blended finance. So it just means that those projects that we're supporting have more potential impact. And this is just a list of all the different kinds of things that we've been doing. But the main point I want to make on this slide is that that impact is ultimately what we're aiming for, and having ways to measure it and to link the subsidy to that impact. One thing we're trying to work on now, which is some of that new area, is because our board members ask us this, is, why did you use that level of subsidy in this project and this level of subsidy in that project? And that's a harder answer, a harder question to answer. And we can say about, if you look at the project cost of IFC, the projects that IFC finances, when we use blended finance, the subsidy calculated is about 4% on average of the project costs. So that's one reference point that we use. And so when we see new projects, we can use that. But it's kind of a rough estimate. And it doesn't link directly to the impact because it just talks about the size of the project. So it's rough, but useful. Now I wanted to talk a bit about just IFC's experience. So here you see since 2010, when we really started using blended finance for climate. That's where we started, and so less than I don't even know, $10 million a year in those first couple of years, and then by FY13, when we started, we had funding for new programs in the agribusiness space, which is the green one, and new programs in the SME space, which is the pink one there. And you can see how our volume of concessional fund use went up, and the amount of IFC investing in that space went up. So those concessional funds helped IFC really extend its reach in climate in those early years, in SME lending, and in agri, particularly related to smallholder farmers, which is what the GAFSP program is designed to support. And that kept us going for about 5 years. And we built up a lot of experience and knowledge. And then that confluence of the SDGs and Addis Ababa and the CEO changing at IFC and saying we need to do more in fragile, low-income countries. And then we got access to this new source of funding, this yellow block, which is called the IDA private sector window, which for those of you that know World Bank and IDA, every 3 years there's a replenishment of fundraising for IDA and a slightly different set of themes to invest in. And this time, $2.5 billion of what was a $75 billion IDA replenishment was set aside for IFC and MIGA to use as blended finance in our own projects. And so that boosted up IFC's access to blended finance. We created the department. I became the director of the department. And now that is part of our portfolio, say, of funding sources. The other increase is climate again. So the blue is we signed new facilities with some of our existing donors. The climate funds here, to give you a sense, are multi-donor funds. So several countries get together, CTF, you guys might be familiar with that, and we access those funds. The GAFSP is an agri-business-focused fund for smallholder farmers. We have 6 donors to that, the US, Canada, UK, the Netherlands, and Japan. I'm missing someone. The SME facility is the UK and the Netherlands. And we've used the Canada money, and then Canada liked what they saw, and we signed some new facilities with Canada. And again, for climate, Canada has certain commitments to invest in climate, and so this helps them satisfy those investments. This is that picture of what we've used the money for in climate, agriculture, SME. One thing I want to point out on this slide is the light blue is the amount of concessional funds. The dark blue is IFC's own investment in that project. And you might ask yourself in SME finance, why is the amount of concessional funds so much less than IFC? And When you look at, say, agriculture, it's a little bit more balanced. That's because of the product that we used in SME finance, which is a guarantee product. So we could do a little bit of a guarantee. We call it a first loss guarantee. So it takes all of the risks for all the losses that happen up to a certain point, and that gets a lot more IFC money to come into the project. Whereas with agriculture and climate, we're using loans, and usually it's $1 of concessional loan for $1 of IFC loan. These are some of the facilities we have under management, the IDA 18 private sector window, climate, agriculture, and SME. Why don't I stop there and take questions? I have some case studies that I can talk through as well, but maybe the case studies will help answer questions that you guys have. Okay, maybe I'll just take a few and then package them or answer them individually. Okay, I'll answer that one. Yep. So it's kind of a similar question. So why don't I answer those two? So how do we create opportunities? How do we deal with less than ideal financial systems? To answer your question, one of the things that IFC has done is help create credit scoring systems and mortgage registries. So it's a basic financial infrastructure for a financial system. And we do that through advice. So this gets to like creating markets is often done through advice. And that advice is related to regulation. It could be related to helping set up an industry interest group, advocacy group, and at a systemic level. Now, the creating opportunities at a project level. So one thing that IFC has done and that blended finance supports is we call it Infra Ventures. So you get the concept of infrastructure and venture capital. And so IFC took a decision, I think 8 years ago, to set aside some of the funds it has to invest in these early stage, development stage infrastructure projects. When you have the developer who is trying to put together a project. So I was involved in one of these projects in Georgia when I was based in Istanbul, and there were a group of Norwegian professionals in the hydropower space who had a project that they were trying to develop, and we helped finance them with some of this capital and some of our sweat equity. So IFC staff would be part of the development team, bringing a lot of technical assistance and environmental and social, and say the financial structuring. So these were technical guys, mostly guys, that knew what they were doing for building hydropower plants, not necessarily so good on finance, and needed some help on environmental and social. So bringing together that skill set to help create that specific opportunity. And we do that a fair amount in infrastructure. And again, part of our IFC 3.0 is what our CEO is asking is each of the industry teams to create a ventures team that does more of that upstream, that's the other term we use these days, is upstream work, to help either at the sector level, and infrastructure could not have the right regulatory framework for renewable energy. Because renewable energy being intermittent and sometimes needs a slightly different setup than what might exist. So we'll help change that regulatory framework, or we'll help at a project level develop the project.
Do I have to use that? Hi. I was wondering, when you talk about your blended finance, Do you all follow the private sector market appetite for projects? So for example, there's a large appetite for energy projects right now. Or can you talk to the investors and say, you have this risk return profile, have you considered projects in water and sanitation or some other sectors that aren't getting quite as much private investment right now? Thank you.
I'll just answer them as I go.
Sure, sure.
So this creating, I thought this was on, but he turned it. So the creating opportunities question and your question are kind of related, because one way we can help create opportunities is working with our existing clients in other markets, knowing them, knowing what their risk tolerance is, the technical capabilities, and then maybe working with our World Bank colleagues. We know that there's some renewable energy project need. One of the stories we tell a lot is in Zambia, a scaling solar story, where the government wanted to create solar power projects, didn't really know how to do that. IFC came in and advised the government on the regulatory framework, the project, the contractual arrangements, and we brought blended finance from one of those climate facilities and put that on the table as something that would be available for winning bidders. Ran a bidding process with the government, and went out and talked to various different power companies that we work with that we thought might be interested, and 2 projects came out of that. Very low tariffs, very successful from that holistic perspective.
Hello, good afternoon. So I have a few questions pertaining to the relationship with IFC and institutional investors. So when it comes to providing technical assistance, is there currently in place a number of programs like academies, for example, that actually train institutional investors on how to participate in private equity? Because the reason I'm asking this question is a number of surveys have been done, particularly in Africa, that indicate that pension funds want to participate, but they don't know how to do so. So I mean, especially when it comes to blended finance. So you're basically doing a lot of the work for them. So I was wondering, is there other academies or more targeted technical assistance programs for institutional investors in developing markets? And my second question is regarding deepening capital markets. So I was just curious as to whether or not, the IFC has considered repackaging a number of these investments in the form of maybe structured bonds or structured assets to actually create a local, create more liquidity. So potentially there could be a more local currency capital market, or a deeper capital market within sub-Saharan Africa, for example.
So on the first question, one thing we've been doing and are now supporting with blended finance is something that we call Sme Ventures. So we like this ventures word. And it's actually SME private equity funds. So private equity funds in fragile, low-income countries that we're targeting. I don't know if that's what the focus of your question was, but I'll answer that question, and if I didn't answer it, then I'll come back. And so what we do is we work with these SME fund managers who are maybe people like you that go back to your country and have some private equity experience working for maybe a big private equity firm, so you kind of know how it's done. You don't have a lot of capital. You go back to a market that's really underdeveloped, so you might not have much of a lending market, and people want to have fixed asset collateral for making loans. You don't have any of that. In the companies that need capital, they need equity capital. And so we work with these fund managers, providing them technical assistance, providing potential investee companies some assistance, again, on putting together business plans and other things. And we've packaged that in this Sme Ventures approach. So we recently supported with this IDA private sector window 3 different Sme Ventures funds to help provide enough capital to make that private equity fund and the manager sustainable enough. When I say enough, it means we're not getting the kind of return that we would normally expect from private equity when we support one of these smaller funds. But we're getting people experienced with private equity in the market, setting an example, demonstration effect, And over time, there'll be others that come in. And so we use the concessional funds also alongside of IFC's own there to help make that happen. We're doing other things at a bigger level of private equity, but I'm finding it harder to use concessional funds when you're with the big boys. Because then there's a fear that the subsidy is not really needed. When you've got someone from the host country who's starting up a management company, trying to do private equity investing, the story around and the potential impact is higher in that story.
Great. So before I take another question from this room, we also have our students from Bologna tuning in, and we're going to go ahead and unmute them because they have a question as well.
Hi, thanks a lot for speaking to us today. I was curious, do you ever impose conditionality or use any other sorts of tools to make sure private sector goals stay aligned with IFC goals, like trying to capture positive externalities?
Good question. We often have often have as IFC, so aside from sort of the use of concessional funds, a lot of conditionality and constraints and in terms of use of funds and on financial covenants and things related to environmental and social performance and integrity. So that is all built into IFC's general operations and oftentimes what we get criticized for by clients because we're too heavy on all of this conditionality. So when it comes to the use of subsidy, all of that is there because IFC is making an investment. It's usually more related to the financial and business and governance of the companies. What we are asking more of when we use the concessional funds is related to getting information about the impact. So we're telling a story at the beginning about why the concessional funds are needed and what the potential impact would be. And if there's one thing that our donors are really interested in, it's that impact. So how many SMEs of what size has our money gone to support lending to? Or how many of those SMEs are run or owned by women? Or what has been the climate impact of the project that we've supported? Or how many smallholder farmers have you reached and what has been their productivity yield increase over time? So IFC tracks those things anyways, but gets a bit diffused through the whole IFC corporate structure. When we use concessional funds, we have this direct relationship with donors, and they've got their measurement and evaluation people. They're observing, and they want to be able to tell the story to their minister about what the public dollars that have been used with IFC, what we're getting for that.
Just a very quick question. I saw that you are trying to focus on fragile and conflict countries and really looking at their needs. But a lot of your portfolio in the past has been on infrastructure. So two-part question. One is, what's sort of the division now going to be going forward between sort of focusing on infrastructure provision versus services that are delivered from that deploying that particular infrastructure, right? Because a lot of infrastructure goes unused or falls into disrepair because it isn't used properly. And then secondly, in terms of just the use of the words, I think there's a lot of misunderstanding when you use the word de-risking, because the way in which you use de-risking is explaining differential perceptions of risk. So looking at how somebody perceives risk versus how you perceive risk. Whereas in the general public, this idea of de-risking means that you're absorbing risk, whereas that really the private sector should be absorbing. So I just struggle with that because I have to explain that also, and I think I wonder why you choose that word.
Mm-hmm. So on the FC, the fragile conflict, trying to do more, and infrastructure question. So infrastructure is one of those main strategic areas, and actually in low-income, fragile countries, what they really need to generate more private investment is good infrastructure. So the two are very much aligned in terms of what can IFC do in these more fragile low-income markets. One is infrastructure, the other is financial sector investments, and the other is agriculture. It's kind of consistently, and you can see in some of the themes there, that's purposeful in a way, in the needs and the opportunities of the countries. When it comes to, so when I mean, my experience has been when you have a private investor who cares about the long-term sustainability of the business, and if it's power or water or road, they're going to make the investments over time to sustain the value. And so, you know, having a private entity either own or be responsible for the operations with the right incentives, I think you are able to get the right type of investments to sustain that infrastructure over a longer period of time than might be the case with a government-owned, because the politician wants to see a nice shiny new road, doesn't want to just repair the underside of bridges. As many of you know, in the US, that's what we really need, but no one gets much glory out of investing in fixing bridges. And the other question about de-risking, yeah, so that has been the term that kind of resonates with our shareholders and the providers, and I talk about rebalancing risk and return as well. But I'll give you an explicit example of de-risking, and it's in the context of institutional investors. So one thing we're trying to do is attract some of this money that doesn't really go into emerging markets. And in the infrastructure space, we set up a program with a couple of insurance companies and pension fund that need long-term assets. And so infrastructure is the natural place. So like in the US or Europe, those types of institutional investors will invest in that asset class. But in emerging markets, because of currency and risk, they tend not to. So what we've set up is I'll get a little technical here, a senior tranche of debt that the insurance and pension funds participate in that is protected by a junior tranche of debt. And that junior tranche of debt is in effect the concessional piece. So the price of it is not taking into full account the subordination of it, right? And what that concessional tranche of the capital structure does is it protects the senior tranche. And the reason that's important, these insurance companies, because of the regulations in their home markets, can't invest in less than investment grade assets. And so this protection, this de-risking of those insurance companies is enabling them to put money so that the money goes into the emerging markets. So that's kind of a classic de-risking where you can link the risk, which is the underlying assets, and that's too high, so I'm going to de-risk, I'm going to remove some of that risk for my senior tranche, and I'm going to take it as the concessional tranche. Now the question is, and your question is also, you know, why won't the private providers of capital take that risk? Well, in this case I gave you, they're not allowed to because of the insurance regulations in their home markets. Now that might be a bit of an extreme, but any investor who's investing their capital is trying to earn as much return on that capital as possible. Now more and more people are interested in some kind of social return too, but ultimately most capital is looking for a financial return. And they're willing to take risk up to a certain point, but more risk means more return is needed. And so if you're able to reduce the perception of risk, so that's the de-risking part, then the investor's like, okay, now it's not so risky, now I'm willing to put my money into that. But if the risk is up here, I don't see how I can earn enough money to take that much risk. So that's the rebalancing of risk and return that at least I like to use.
Oh, there's so many. Thank you.
So sort of follow up on that question, China is very publicly moving into the infrastructure space in developing countries with the Asian Infrastructure Bank as well as the One Belt, One Road initiative. But as we know, they care a lot less about these ESG impact standards that you're talking about earlier. So do you see sort of your role in the IFC with the infrastructure and what China is doing now as additionality, as competition? Sort of how do you view the competing interests between what China is doing currently and the work that IFC is doing in these developing countries for infrastructure?
So this morning I just happened to be asked by some of the people at AIIB to have a conversation about using blended concessional finance, because various different Chinese sources are now, I think, offering to AIIB. And AIIB is one of the multilateral development banks, and they have, as I understand it, similar principles. Now, direct sources of funding from different parts of the Chinese government might have less in terms of environmental and social standards, but it's changing. I mean, and I think China's changing with what many African countries and African societies are asking. I mean, China itself is having to change in reaction to what Chinese people are saying. I don't know if any of you listen to the daily podcast from the New York Times, but this morning it was about China, and in terms of it's really interesting. I think you guys would all find it interesting comparing China with the U.S. and its sort of political model, and having really survived when many in the 70s and 80s here in the U.S. thought it wouldn't, because you had to have democracy with capitalism. So there is something, they have a different model, and it has benefits and detractions. I think when it comes to standards, they are seeing the benefit of applying standards rather than just looking at strategic interests in Africa in particular. It's not to say that they're not prevalent in many African countries and in different ways, but I think things are changing, and this morning's request to meet with me to talk about our blended finance principles is like one little piece of that change.
Great, thank you. So I had a quick question about the DFI mobilization feature that you mentioned earlier, and when it comes to selling loans to commercial banks, are these loans held to the same standards as if they were purely private market? So for instance, same securitization techniques, same risk assessment techniques, things like that?
Well, when IFC is kind of packaging a loan to sell to them, I mean, we're using our same standards, and that's one thing that a commercial bank will like, because they know that the Equator Principles have been applied and they can kind of tick that box, and that's part of the value add of participating in what we call a B loan or syndicated loan that IFC offers to them. And in different types of, there's not just loans that we use as structures, but like this insurance, pension fund, infrastructure platform that I mentioned. So that's also something that's interesting for those companies as well, to be able to feel comfortable that at the end of the day, part of it is we feel good about what they're doing, but it's probably more related to the backlash that would come if something happened in the project they invested in, with their shareholders or the public at large.
Martin, thanks again for coming back and sharing all this information with us. I want to go to the impact measures, so the whole AIMM framework that's relatively new. But you've been at the IFC now more than 20 years, and so you've seen a lot of impact measurement systems and screening tools to make decisions about investment A versus investment B. What strikes you as particularly new about these standards? You've talked about the rating and the points that are associated with it. What impact have you seen so far? First of all, what's different about it from the past tools? What impact have you seen so far? And what would success look like maybe in 5 years if they are implemented well and effectively?
So until this new system, AIM, I'll call it, we would tell a story about the impact, and we kind of told the same story repeatedly because it was easy, and it worked before, and it should work again. I'm sort of ad-libbing it, or I'm being a little bit flippant, but it's not too far from the truth. And we had a tracking system for metrics, and that was pretty serious, and we still have it. So if you were doing a a school, you would track how many students were differential from today, the benchmark, to the future, or a hospital, how many patients, or how many farmers you were accessing. So this delta, we've been tracking and we report on that, and that's a pretty serious. You just look in our annual report and you'll see those metrics. And we called that the Development Outcome Tracking System, DOTS. It wasn't very popular because it was perceived more as a compliance thing that you had to do when you were managing the portfolio of investments, and it might be difficult to get the information from your client, and it didn't seem to be much value because you told your story already to get your project approved, everyone believed it, and now you had to do the real work. So with AIM, a couple things are different. One, it's generally, it's related to both the project and the market. And while our stories before is sometimes related to the market impact of what we were doing, or at the project level, how many farmers were going to be impacted. But this puts it into a framework of, we measure the impact on a project level and on a market level. And so the composite score from 0 to 100 is taking into account both the potential project impact and market impact. And so you see, I think this was a brilliant decision, because you can see sometimes the project, it's not going to have that much impact because it's small, because there's a magnitude size involved in that. But it's in a small country, and it's the first of a kind, and if it works, it'll be replicated. So the market impact is high. And so where the project impact might be low, the composite score might be pretty good because you're anticipating a big market impact. So having these two parts of the matrix is new and help make the whole process a bit more rigorous, and to help tell the story, then you tell the correct story. And it's backed up by the numbers there. Then the other part is the probability. So we assign a probability score for those impacts. So in a well-developed market, oftentimes the probability of the impact happening at the project level is pretty good, because there's no daily market barriers or issues, and you've got a good sponsor, and so that might help your score. But you don't have much of a market story in that case. But the probability helps people both tell the story and be honest with themselves about the challenge. Say, working in a fragile or conflict state, the probabilities are often low compared to a Brazil or an India or a China project. So that's another design element that wasn't there before. And I think like the real change is, well, and the score is independent. So before, you would tell your own story and your boss would believe it, and your boss's boss then believed it, and the board believed it. And there wasn't a clear independent check on it, and now there's a clear independent check. So, and by economists that do that score, and they go through a review process, and so the culture changes. Now investment teams are caring about what that score is, because it gets reported. Their directors, they're the people making decisions. They're like, okay, well, what's the AIM score here? Because it becomes a tool then to decide, if I have scarce capital, where do I put it? We need to make money, but we also need to have impact. So and then finally, there didn't used to be a really clear way to measure people's performance based on impact or anticipated impact. But going forward, that AIM score and your personal scores on your projects will be part of your performance assessment. So that's another way to bring like the change in culture, which is always important in organizations.
So we're going to go ahead and take one more question, if anyone has one. Okay. Great. So I'll go ahead and give you the last word if you have anything else to add.
Okay, I had one last slide, so I'll use that as a cheat sheet to. So I hope you found the talk interesting and have a better understanding of what blended finance is, at least how we at IFC use it. It's not a silver bullet. It's not going to be the solution to economic development, but it's part of the broadening toolkit. I from what I've seen over the last year and a half, it's quite helpful to get IFC to invest in places where it hasn't, and that means others are investing. Partnerships are really important, either with the donors or with other DFIs, MDBs. I talked about within the World Bank Group, the importance of working together. We're able to do things we couldn't do before, so that demonstration impact is really accentuated with blended finance. And assessing this risk return. So your question about, well, the private sector, they should take those risks. It's improving the understanding across a wide range of development players of what is acceptable risk return, what does that balance mean, and that's where sort of the private sector focus and understanding helps. When I work with someone from the UN, I went recently to the Kakuma refugee camp in northwest Kenya, where we've done a market study. So what is the market of Kakuma and the neighboring Turkana region? And just doing that study brings like the manager of the camp into a conversation that's not a normal conversation for a UN refugee camp manager, and trying to understand the risk return allocation. So I'll finish with that, and I'll stay around and eat a little bit if anyone wants to chat privately.
Great. Thank you so much.